In options trading, can a losing trade still be a win? I think that answer is yes, if the strategy playbook helps you avoid the full loss. Okay, welcome back, guys. Let's take a look at the trade recap for Thursday, May 7th. All right, so not every trade is going to be profitable. That is part of trading. But if the system gives you a defined entry, defined risk, and a defined way to manage the trade when it goes against you, that can still be a successful execution of the playbook. And that is really what happened on Thursday. This was not a winning trade, but it was a good example of why I use a time-based management system for losing trades. Coming into the day, the conditions were lining up for a directional trade with a bullish directional bias. As always, no directional trades are taken in the first 2 hours of the session. And I want to point out, guys, I have the session that we're talking about highlighted, and I also have the first hour range marked inside the box. So after the morning restriction is out of the way, we're looking for a valid directional setup. Right around 10:30 Central Standard Time, we get a signal candle close above the high of the first hour range here. And I want to clarify something. I'm not simply trading open range breakouts. The first hour range is one of my key levels, but the trade is not taken just because price breaks out of that range. In this case, the breakout happened to line up with my directional method. We had bullish structure, we had the signal, and price had moved above the first hour range high. So at that point, the setup was valid and we entered the directional trade. I got the alert out yesterday at 10:35 Central Standard Time. We sold the 73.80, 73.75 PCS for $230 per lot. So our position was here. My short strike is the dotted line, long strike is the solid line. Now, as I said at the beginning, this trade was not a winner. Almost immediately after entry, price fell back into the first hour range. Then it actually broke below the range and continued selling off for most of the remainder of the day. So the directional idea was wrong, but where we did win was in the management of the loss. We did not sit in the trade and hope it came back. We exited after 30 minutes based on the time-based method for managing losing credit spreads. And you can see here, I bought this back at 11:07 Central Standard Time for $380. So we sold the position for $230, bought it back a half hour later for $380 for a $150 loss rather than a potential $270 loss. So I use different management windows for different trade structures, and I'll get into those in more detail in another video. But for credit spreads, my current rule is a 30-minute check. The reason I use a time-based system is because it keeps the process simple. It doesn't require constant screen monitoring, and it helps eliminate emotional decision making. You know when to check the trade, and you know what condition would cause you to exit. It's a binary decision. If you've followed me for a while, you know I used to run systems with zero management, and honestly, that can work. You can build an edge that way. The reason I've embraced managing losing trades comes down to one major thing. Losses tend to cluster or occur in streaks. If losses were perfectly spread out, managing them would not matter as much. If you had a 65% win rate and the losses showed up evenly every few trades, the drawdown would be easier to handle, but that is not usually how real trading plays out. This matters because maximum drawdown is going to dictate position sizing as well as the overall scalability of your trade approach. So when I talk about managing losing trades, I'm not just talking about saving a little money on one individual trade. I'm talking about keeping the maximum drawdown contained over a long series of trades, because if we can reduce the damage during losing streaks, we could potentially size the strategy more efficiently and make the overall approach more scalable. That is why this Thursday, May 7th trade still matters. The entry didn't work, the market rejected the breakout, came back into the first hour range, and then sold off. But the strategy playbook did its job. We had a defined entry, we had a defined risk structure, and most importantly, we had a defined management rule that helped us avoid sitting in the trade all day and taking the full loss. So the takeaway from this recap is pretty simple. Not every trade is going to win. But a mechanical system should not only define how we enter winners, it should also define how we handle losers. This is still a successful execution of the playbook. If you want to follow these trades in real time, you can join the group using the link below. I post the trade alerts inside Discord, and alerts are also sent via SMS as well. And if you find these recaps helpful, give the video a like and subscribe for more 0 DTE SPX trade breakdowns. I'll see you in the next video.